All right,
I know Wally says the act has been passed and nothing can happen, but this is Nigeria. Okay. Good morning, distinguished guests, partners, and friends. On behalf of the CardinalStone Group, it gives me great pleasure to welcome you to the CardinalStone Breakfast Dialogue. This event was conceived as a platform for high-level engagement where policymakers, private sector leaders, and experts can come together to share insights, challenge assumptions, and find clarity amid complexity. Global economies are evolving faster than ever, and investors must be positioned to understand shifting landscapes and anticipate change. As an investment and multi-asset management firm, our purpose at CardinalStone has always been simple: to help our clients make confident, informed decisions in a changing world. Today's conversation speaks directly to that mission. As we all know, the only constant in life is change. And with every change comes opportunity. Nigeria is entering a new tax era, one aimed at strengthening our fiscal base, promoting fairness, and improving compliance. I don't know about that fairness bit. But these reforms are vital for national growth, yet they also raise important questions for the private sector. Today's dialogue is about unpacking those questions together. We're gathered here this morning not only to understand the policies shaping Nigeria's tax landscape, but also to explore what they mean for investors, businesses, and families. I would like to especially recognize Mr. Michael Olufemi Olarinde, who will deliver our keynote address. Mr. Olarinde is a respected expert and leader in tax policy and administration, and we are privileged to have him share his insights with us today. To our esteemed speakers, the goal is not just to listen, but to learn and leave here better equipped to make strategic, forward-looking decisions. Once again, welcome to the CardinalStone Breakfast Dialogue. We're delighted to have you with us.
So she's hopefully set the tone. And as you can see, we're trying to get it moving really quickly because, without further ado, I'd like to now welcome to give us a little context into the conversation around tax, just to provide a little highlights of the macro story right now. I want to invite the chief economist at CardinalStone, Lalu Boboye, to deliver a presentation on just that. Please put your hands together for him as he steps forward.
Good morning, everyone. You're welcome to this session. This is going to be very quick. I'll do a quick run through of the Nigerian macros and how we can strategically position. To start with, please let the slide come up. To start from the global perspective, this year has pretty much been challenging, and that has been the trend over the last 3 years, largely because of the action that we saw from Trump. That's the US president. We saw that led to a lot of unsettlement in the global space. Aside from that, we saw the dollar weakening materially. The argument for the weakness of the dollar is not surprising because over the last 2 years, dollars has largely been overvalued. We had initially anticipated that we're going to see a correction, possibly in 2024 or even in late 2023. However, we saw that the correction happened in 2025. Currently, the dollar is down by about 8%. When I mean dollar, I'm talking about the DXY index. It's down by about 8% because of the policies that we're seeing from the US governor, president, because of the debt story that is going on in the US market. If you've been following the trend, the US market is currently having a huge ballooning debt, right? And it's becoming worrisome. And all this, and then because of the policy action that we saw from the Fed authorities, all this has accumulated into the weakness of the dollars. Aside from that, let's go to the next slide, please. Aside from that, we've seen what is likely going to happen to dollars in 2026, right? Different school of thought. Where we stand, we think that dollar is going to be pressured next year, but the pressure that we're going to see next year is going to be minimal. We're looking at single digits, somewhere below 3%, compared to the 8% or in excess of 8% that we've seen this year. We think that the US Fed We do more rate cut next year, largely because of the job market, and we also expect inflation to taper a bit in the US market. For gold, we've seen a lot of interest in gold, and two reasons or two key explanations for this. Number one, because of the weakness of dollars, investors are trying to protect their assets, and we're seeing them buying gold. But interestingly, we are seeing central banks across the globe stack up more gold, right? And that's because there are conversations about the dominance of the dollars, for how long, right? And that has led to the current holdings of central bank in gold is higher than that of US treasuries. This is the first time in over 15 years. And again, Nigeria too is also in this category. Nigeria is also stacking up gold. This started since 2023. We've been buying more goods. We've been having more goods reserve compared to what we used to have prior to 2023. Next slide. Coming down to Nigeria, what do we think will happen to Nigeria? From a growth perspective, we think that the growth trajectory for Nigeria has largely been positive. The reforms that government have initiated have led to positive sentiment. But beyond those reforms, right, we're beginning to see confidence being restored into the economy. If you've monitored what has happened over the last 2 years or 3 years, because of the policies that the government initiated, we saw that, there was a bit of sentiment, improved sentiment, that those policies are good, and they're likely going to yield positive return in the medium to long term. However, we've seen that from individuals and businesses, the sentiment has largely been weak. We've seen consumers' purchasing power weakening materially. We've seen consumer sentiment weaken. We've seen business sentiment weaken, using different gauge that is available to us, right? But one thing that we're noticing of late is that we looked at the business confidence survey of late, and what we're seeing is that businesses are more optimistic than the way they used to be. If you ask even people that are not savvy, they give you the perspective that things are getting better. Inflation is coming down. FX is relatively stable. You can predict FX now than before. In the last 10 years, we've seen a series of devaluation of the naira. But going forward, the expectation is that as long as the trajectory that we're seeing from the CBN is maintained, you expect sentiment to improve, right? So inflation coming down, FX becoming relatively stable, bodes well for growth story. So we think that the economy will do about 3.9% this year, and we're likely going to see the economy doing 4.1%. When we look beyond 2026, we think that Nigeria is gradually moving to the point where growth can move close to 5% level, right, in the medium to long term, especially if we see policy continuity and then we see improved, reforms. Next slide. On the fiscal story, I know that we are here for the tax, and I'm sure that we're going to hear a lot about the tax policy. Please, let's move to the next slide. I won't speak too much on the tax. I will just speak on the broad implication on the fiscal story for Nigeria. We've seen the Nigerian debt jump. The latest numbers that we have as of Q2 shows that the debt level is around 153 trillion, right? And we've seen people provide different analysis, and people have provided their worries that Nigeria is moving close to a territory where our debt is becoming unsustainable. For how long will this debt continue? It's good to provide context. Number one, 75% of the organic debt movement that we've seen in the last 2 years has largely been driven by FX. So if FX issues were not prevalent, we would have seen a minimal increase, right, compared to what we have. Now, given the fact that we expect FX to remain stable going forward, it means that the risks of FX issues ballooning the debt is out of the place. Secondly, is when you look at the Nigerian's debt level and you compare it to debt sustainability metrics, be it debt to GDP, debt servicing to revenue, what you see is that the metrics are improving. For example, debt to GDP is expected to close the year at around 42%, and by next year, 44%. This is materially lower than what the IMF has set for countries like Nigeria, about 65%. Aside from that, debt servicing to revenue, which used to be in excess of 100%, is currently around 65%, which means that things are getting better. So we don't think that our debt level is moving to an unsustainable path. We think that Nigeria's debt is still pretty much sustainable. And we expect that revenues next year will largely be driven by the non-oil sector, largely given the fact that we expect oil prices to tank, because that's the expectation. Oil prices are going to be weaker because of oversupply and weak demand that we're seeing from the global markets. That means that it's going to be non-oil sector. And interestingly, according to the president, the non-oil target for this year was achieved in August, which means that there is more optimism going forward around the dynamics of the non-oil revenue. The taxes that they want to introduce, we think that is to broaden the tax net. That will lead to better capturing, that will bring better efficiency, and that can lead to improve revenue from the government. A report that was done by the World Bank in collaboration with the IMF and the Budget Office in 2021 highlighted that more than 95% of the rich in Nigeria, they either avoid taxes or they evade taxes, right? So the tax is not to put pressure on those at the bottom of the pyramid, as some people have suggested. And people have argued that you are putting a pressure, and people have argued that you are putting a pressure on an economy that is recovering. No, it's basically to tax those that have not been paying taxes appropriately. Next slide, which is on FX. The next slide, please. The issues around FX has largely been resolved. Before Cardozo came into power, what we saw consistently was capital being trapped into the economy by foreign investors. We have elevated backlogs. We have arbitrage in the market. There was premium between the parallel market and the official market. What we have at the moment is that the premium is close to zero. We've seen the Naira appreciated materially. It has moved from over 1,550 levels that we saw some months ago to below 1,000. It's currently around 1,460 as of yesterday, indicating that things are getting better. And some school of thought believe that the appreciation that we're seeing in Naira is largely influenced by the interventions that we're seeing from the CBN. Why the CBN is intervening, it's also good to provide context so that people are not confused. Number one, if you look at the intervention that the CBN is doing, currently the CBN is doing a monthly average of maybe about $200 million to about $300 million. If you compare it to what Emefiele government used to do, Emefiele used to do at a point about $3.3 billion on a monthly basis, which means that we are not even doing 10% of what we used to do back then. And Cardozo has come out to say clearly that the intervention that he's doing is not to achieve a particular level of Naira, is to ensure that there is adequate liquidity and they will only come to the market when necessary. And looking at other factors, we think that the Naira appreciation that we're seeing is justified, right? We even think that it could get to 1,004 by the end of the year and coast within a range of 1,003 to 1,004 in 2026. And I love to look at it, or we like to look at it from a fundamental perspective. The best fundamental gauge and position is telling us. As of last year, Nigeria's current account position in 2014 was about $16 billion. That's one of the highest we've had in a long while. That's surplus position. This year alone, as of H1, we've had about current account surplus of about $8 billion. If we annualize that rate, that's about $16 billion by the end of the year. Balance of payments position as a percentage of GDP is currently around 6%, which is pretty much good and solid for the country. We think that that is good. We think that FX reserve could move close to $45 billion by the end of the year. The government wants to do some external borrowings. We are hearing that they want to do international sukuk bond. They might be coming into the Eurobond market to do, cumulatively, they want to do about $2.5 billion. If you add that to our net, to our current reserve that we have, we think it's positive. And then when you also look at the reserve from a net position, it's just obvious that the reserve is in a more solid position, which provides a lot of comfort and respite for the country. And lastly, is despite the old worry that next year is pre-election year, how will foreign investors behave? We try to look at how investors typically behave in pre-election years. And we notice that what triggers foreign investor has not always been the election, but rather things that have been happening before the election, right? If confidence is in the market, investors will be confident even during pre-election years. Take, for example, during the last election, we heard, no official data, that they were paying delegates in dollars. Those dollars were coming from somewhere. But at the moment, even Cardozo is not financing it's not doing back-end financing for the government, which means that the access to dollars by politicians is not there again. It has to be through official means or through proper means, which means the risks of excessive demand for dollars during election years might not be there. Secondly, foreign investors that we've engaged, they are much more optimistic even than some of the Nigerian investors. For them, despite the election year, they think that there is still more benefits for them, be it in the equities markets or be it in the fixed income markets. I said lastly, but this is lastly, we think that monetary action, they will do about 200 to 300 basis points rate cuts in MPR next year. We also think that inflation will be moving below 15% by end of next year. Thank you. Take questions.
Thank you very much, Laolu. Please can I put a hand together again for him? I think that was refreshing, positive news, a lot of things to consider as we go into 2026. So as he mentioned, we'd like to take your questions now. So if you do have any questions regarding the outlook for the economy, maybe some element of presentation, we're happy to take those now. Signify by raising up your hand. And as you do so, we'd appreciate if you can introduce yourself briefly, and we'd love to take your questions. Right, we have a hand there. Can we bring the microphone to the gentleman towards the middle? Please, can you raise your hand again so they can find you? Thank you. Is the microphone on? Can you confirm that it is? Thank you.
Hello. Yes, it is. Good morning. My name is Sheon Olufeko. I work very closely with the CardinalStone team members. I just have a question in terms of the global outlook and in terms of the global equity position. I think you mentioned that there'll be more rate cuts next year. And I think you mentioned, put a comment there around who the next expert chair would be. What's the implication of all of that in terms of Nigeria, particularly Nigerian equities and the fixed income position in Nigeria? Thank you.
The implications of that?
Yes.
Got you.
Okay, so first, I'll pick the second question. I'll start with that. We don't know who the Fed chair will be. We don't know the policies that he will be bringing on board, right? But one thing is clear. Historically, the Fed chairs are inclined to bring down inflation to 2% levels, which is like the long-run average for the U.S. market. So the job market appears to be the front burner at the moment as against inflation. Right. So we think that regardless of who comes into power, we leeway to do more rate cuts here in Nigeria. So take, for example, about 6 months ago, almost 1 year OMO rate used to be at around 26 to 28%. But currently, OMO rate has come down to about 22%, all because we've seen the US Fed cut rates and look for where they can put their money, where they can get good rates. We think that they will come to Nigeria. Nigeria's carry trade is currently attractive in excess of 22%. And you know, the interesting thing about carry trade is two functions, right? The FX implication and then the rates that you're offering them. FX implication is no longer there. The worry is no longer there. It has reduced materially. So the only worry for them is interest rate differential. And interest rate differential is solid. So we think it will support foreign investors to come into the market. If you look at the numbers that the equity, we think that that will support sustained foreign flows. Yeah. Yeah. Mm-hmm. So it's not. I didn't compare, right? I think that Nigeria standalone, compared to what we've had historically, we're going to see more interest or improved foreign interest in the market. So relative to the global market, I think it will be influenced by other factors beyond macros, right? You have to look at what the numbers have seen, policies from the US market, how the market has moved, you know, undervalued stocks. So it's going in terms of allocation. I still think that we are still going to see maybe a bit of allocation to Nigeria, right, compared to the global market. No. Carry trade is still there, but lower than what it was at the start of the year.
Thank you for asking about 6 or 7 questions there. Well, it's all good. We enjoyed it. Thank you. Okay, I have a question from those joining the years to 2026 gains. or does it apply to gains made in the year under review? Actually, I guess we should probably reserve this for the tax conversation. So yeah, I apologize. I should have picked that up. Do we have any more questions in the room? Yes, we have another hand here. We'll probably take maybe two more because we want to keep this tight and then go into the tax.
Right. The CBN had employed these monetary policies by very high for even SMEs and MSMEs.
Money supply accounts for about 40%. This is like when you look at it on a 40-year basis. Money supply accounts for about 40%. FX accounts for another 40%. And 20% factors that cannot be benchmarked to a particular driver, so multiplicities of drivers, right? FX, like I said, is positive. So which means 80% that is influencing Nigerian FX, that is influencing Nigerian inflation, is largely biased to the upside at the moment, largely positive, which means that risk of further inflation is very minimal. Now, the other 80%, you can bring in food inflation, you can bring in easing, right? Food prices are declining compared to what it was a year ago. And not just because we are entering the harvest season, even in the non-harvest season period, when you compare likes for likes, food prices are moderating. So we think that we are in a downward trend for inflation, which makes sense for the CBN governor and the CBN management to cut rates. You want to support the real sector. If you look at the manufacturing trade, both were for interest rate sensitive sectors, right? Which is clearly a good one. So
So, if we would please project the profile so you can get a sense of who our speaker is. We're really delighted to have him join us today. This tax thing obviously is a hot topic, and there's so much uncertainty about what it means for us as individuals and, of course, as business people. So we're delighted to have him join us. Are we projecting the... Okay, if not, I'll just read before we moved on to the tax bit, but perhaps it will come up during the panel session. All right, so our next speaker, who will be delivering a keynote address to really set the scene for the conversations we're going to be having most of today, is none other than Mr. Michael Olufemi Olarinde. He's a seasoned tax policy and administration expert with over 20 years of experience, and he has contributed extensively to tax policy, legislation, and research, earning recognition nationally in Nigeria. And he's a very frequent speaker at many conferences across the world. I'm told that he has done that in as many as 20 conferences globally. He's the head of Fiscal and Tax Reform Division at the FIRS, and he will be delivering his presentation now. So please put your hands together as he steps.
And produced the Nigerian Tax Reforms Act 2025. And it marks the most comprehensive and recent history aiming for simpler, fairer, and more competitive system to drive our system. I want us to all imagine Nigeria like, if I say Nigeria, liken it to maybe a house. Now the house, you can, for many of us, we can recollect, we used to have, in fact, not just recollect, we still have mud houses till today. There are villages you go to, you see mud houses. And that's what they have there. And people who live there believe that they have a house. But I am sure for people who have gone outside of that community, know that that community is away from having the best. So today's houses are smart houses. And for you to be able to deal and to be able to enjoy the good things of life, you need to now move from that mud houses to smart houses. Or liken Nigeria to a vehicle. We're gonna days where we have vehicles that you need to manual engine, manual transmission, and the likes. You can drive them, the likes of the 504, we used to have those days, Peugeot, or the Beetle. Now moving to what we have today, when you have like a Tesla truck, cyber truck. Imagine comparing the two of them. However, we all deal in the same global economy. And so how efficient can the system be moving from this old generation? And why am I speaking about this? We had laws that were 1939 laws, and we are still operating them in today. So how can that law fit into our system today? Can I move to the next slide, please? So there was this transformative. The system is now a comprehensive review of our tax system to provide a transformative to transform the system. And it is to simplify compliance. Aimed and provide clarity and coherence to how we deal in the tax system. The next slide, please. And there were principles upon which these tax reforms were built on. Simplicity, harmonization of system, to be taxpayer focused. The system should be taxpayer focused rather than speaking to government making revenue. And also, it should be data driven. If government is going to say a class of persons should pay a type of tax rate, how did you arrive at that rate? Not just pick type of tax rate. How did you arrive at that rate? Not just people sitting down in a room and determining a rate. So what is the data we have? It should be modern tax administration. You can't be collecting digital taxes with manual administration. So government had to move. Then our tax system should be competitive. Businesses should not say, oh, Nigeria have this rate, so I think we should. But the system should be competitive. It should also encourage people to be productive. And it should ensure neutrality of business profits. So tax should be a consequence of prosperity, not when businesses are still struggling, you're taxing their capital. So it should be neutral, aligned with government policies, which we said they should tax the prosperity and not poverty, tax the fruit and not the seed. So eradicate any form of taxes that depletes capital of business. And it should conform with global practices, of course. We are not an island. We have international and cross-border, and we should align with that. Next slide, please. Now, align with that. Next slide, please. Now, what is the reform we are talking about? We have 4 new tax laws. The Nigerian Tax Administration, Nigerian Tax Act. The Nigerian Tax Act is a single law that harmonizes every imposition provision for taxes in Nigeria. So it tries to harmonize the taxes from every angle. Today, how do we know the tax laws we have? I'm sure even me as a tax administrator, I don't know how many tax laws we have. Because when you check, you may think you've seen it all. Then you just hear about one tax from an agency's law, which is imposing tax. And so the work was also to ensure that we harmonize everything in a book where investors can easily know everything, all the taxes. Nigerian Tax Administration Act also speaks about the administration of taxes, the rules that tax administrators will follow to administer taxes, while the Nigerian Revenue Service Establishment Act provides just for a change of name and the establishment provisions for the today FIRS, changing the name to NRS, just to project its mandate at taxation in Nigeria. So today you go across different states, you see different tax standards. So the Joint Revenue Board now should standardize those provisions, provide even a common service for them so everyone can be on the same. And that law also now sets up, re-establish the Tax Appeal Tribunal. and reestablishing the tax appeal tribunal so it could provide that sense of independence. Today, the tax appeal tribunal provision is embedded in the FRS Establishment Act. So it has made people feel, oh, this may even be an appendage of the service. However, the law now says, let's even make it not just perception, let it be seen that people know that actually it's independence. And now provides a provision to support tax service from tax administrator by establishing the office of the tax ombuds. And so with that, if a taxpayer is aggrieved of getting on equal service from the tax administrator, he could get an arbiter that help to push this. And let me speak to some of the next slide. Some of the provisions that affect corporate income taxation. We have the companies are now reclassified as large and small. And when they are large, the tax remains at 30%. But the small companies, which now have a threshold of 100 million, moving from 25 million now to 100 million, have to pay tax at 0%. So they do not, however, they need to file tax returns. Now, if a company has a threshold of less than 100 million, however, have net asset of about 215 million, will not be classified as a small company. So those are some of the things we need to also know. And the tax rate for small companies, okay, I've explained, is 25%. Then we have earmark taxes today that are here and there. There are so many earmark taxes, like the one I explained. Some laws have provisions for taxes. You all heard about the cybersecurity tax, cybersecurity levy, and you know about today's tertiary education tax, you know about the NASENI levy, you know about the NITA levy, you know about, so government now try to harmonize all this levy into one single tax. And in harmonizing, it has also reduced even the rates, because when you put together all the heads, it goes even beyond 4%. Now you have a 4% single rate, so it reduces the cost of even compliance and the process of compliance. Minimum tax is now repealed to ensure that businesses who are struggling to survive will not be taxed on their capital. So there's no minimum tax again. Now, however, we have something called the global effective tax rate. And now the effective tax rate provision is for large MNEs, which have 750 million euros global turnover, and all large companies with 50 billion turnover, which are going to be charged at a global effective tax rate, or at an effective tax rate of 15%. And so this is some of the new thing we need to note. Now, when we talk about investment, there's one tax that always comes to fore, the capital gains. Capital gains now is being harmonized with income tax, whether it's corporate income tax or personal income tax. So because income tax now is referred to as income tax, taxation of income of persons. So whether a person as a natural person or person as an individual person. So now it is expected that everyone who have capital gains just add such capital gains to their income, and it will be taxed accordingly based on the progressive tax rate the person may fall within. So if it's a small company, it means that such gains will be charged at 0%. If it is a large company, it will be charged at 30%. The rate of 30% is expected to be reduced by the president. Now, it's not that when some people say, oh, capital gains is now 30%, it is not direct like that. Because now you are expected also to be able to, if you have been making losses before now, today, if you dispose an asset and you make a gain, you pay capital gains tax. However, you are not allowed to relieve losses. Now, consequently, what you're now going to be doing, you can relieve your losses. and whatever is still remain of your income is what will be taxed. So next slide, please. So so we have tax deductibility of interest and expenses. Businesses are now allowed to deduct income incurred that is only and exclusive in generating taxable income. This has taken away the discretion of reasonability, which tax administrators normally subject this test to. So where it is wholly and exclusive to that income, such will be allowed, such expense and interest to be allowed. Also, gains from the disposal of shares, that is below 150 million is now exempt from tax. However, and another condition, the proceeds should not exceed 10 million naira. That's the gains, rather. Should not exceed 10 million. And if such is reinvested, it will equally be exempt. However, the investment should be in Nigeria where it can actually be confirmed that it was reinvested. Indirect transfer of shares. Gains from a non-resident transferring shares are taxable if the changes ownership of a Nigerian entity. So you don't just sell shares offshore and there's an impact on a Nigerian entity. So because there's going to be an impact whether it's a loss or a gain. So it's also expected that the Nigeria business can benefit from whatever, Nigeria economy can benefit from whatever happens because of its association with such business. Tax ID is now a requirement for every financial institution who operates to receive from their taxpayers, their customers. Is a requirement. And what is a tax ID? The tax ID is supposed to be a unifying identity framework for all persons who are in business. Now, when you say unifier, there's an attempt to harmonize all forms of identity we have today, whether it's the TIN, it's the NIN, it's the RC number, and every other forms of identity. So at the end of the day, we are going to have only one form of unifier. So whichever you have will now be used as your tax identification. So the next slide, please. So capital gains tax relief. Okay, I've spoken about it. I've spoken. Okay. Well, now crypto assets. For those who are investing in cryptocurrencies and other digital assets, there's now a reporting framework for everyone who operates, who are trading or operate in these forms of assets to report. And when they report, it's expected that they are supposed to pay tax on the gains they make. They are also allowed to relieve their losses. So we know the way this business moves. Many people can make gain today, and tomorrow there's so much losses. So it's allowed for them to relieve their losses when they make gain. However, for businesses who have multiple portfolios, it is only expected that you can relieve the losses from digital asset of cryptocurrencies from gains from the same class of assets. So next slide. Requirements, okay. Now, key provisions, neutrality of intra-group restructuring. So when you're doing an intra-group restructuring for businesses, there's an exemption from tax on the capital gains, and even stamp duties from there is also exempted. Stamp duty exemption of transactions. So stamp duties has also been reformed to ensure, to maintain something that is help the business community and exempting a whole lot of transactions. So business transactions under 1 million naira, contract of labor, goods sale and sale of merchandise are also exempt from stamp duties. This will support low-income earners and MSMEs. Now, going to the VAT. VAT today impact business so much. Many people don't even realize that much because we have what we call restricted input VAT. So sometimes we received people from the IMF, and the person that led the team was a Chinese man. And so when he was expecting to see output minus input, and that is, but when he was calculating, we restricted. And he was arguing that this is not how VAT is being calculated. So we told him this is the Nigerian version of VAT. So however, we are moving past that now. The VAT now is unrestricted. If you purchase an asset and you get VAT on them, you can claim it from your output. You can claim it from the output and services. Now you can claim the VAT on service received. You can claim VAT on overheads. On a broader economic and global dimension, globally, the 2025 reform positions Nigeria as a credible voice in international cooperation. They align with the OECD Pillar 2 and UN Tax Cooperation Framework. The AML and the CFT standards ensuring that Nigeria remains compliant with evolving global norms. Reforms aim to transition Nigeria from a revenue-dependent to a productive-driven economy. My principal, Dr. Zach Adedeji, once said something, often says, fiscal reforms is not about taking more, it's about making more possible. And by fostering enterprises, transparency and innovation, these reforms create fair and sustainable platform for long-term national growth. And let me run through some implications for business and investors. Next slide, okay. So investor confidence. This should provide investor confidence. Unified legal and framework should offer clarity and predictability and to boost Nigeria's investment. Lower compliance costs. We expect that this should lower because of the reduction in taxes and exemption of many classes of businesses. Also, it should provide strategic incentive tax breaks. I didn't mention about the priority sector, allowing many more business to be given what we call a tax credit today. So businesses will get tax credit rather than pioneer status. These are also, I believe when in the other session, we will deal with it on Q&A. Corporate governance, now mandatory unified team, we help. Cross-border investment, it's also something to consider. And the impact on across industry, different sectors will benefit with clearer tax rules and to strengthen taxpayer and government relationship. Transition and adaptation requirement, it is expected that businesses will continue to invest in technology so they could now operate smartly. Greater certainty, lower compliance costs, and stronger governance. And in conclusion, a shared responsibility, as Franklin said, Benjamin Franklin said, he said, nothing is certain except debt and taxes. And in today's Nigeria, reform is just as certain too, because the global world, the tax world, and the business world keep on changing. So tax reform requires a public-private collaboration in promoting financial institutions must lead by example, promoting compliance and trust. And to business leaders, we ask that you adopt smart digital systems, use available incentive, engage tax authorities, and together we can build a fairer, modern system that drives growth and prosperity. Thank you for listening to me. We will await all the questions that may come after now. Thank you.
Thank you, sir. Thank you very much for that very robust presentation. So much to learn from there. And I imagine that we have questions, and we will certainly be taking them shortly. But before that, I would like to just run through a few housekeeping things as well. First of all, I'd like us to please recognize and welcome the chairperson of CardinalStone Asset Management. She's none other than Mrs. Miriam Bashir. Thank you so much for joining us. Of course, we also have one of the co-founders of CardinalStone joining us, and you'll be hearing from him later, Femi Ogujimi. All right, and before we get into the panel, just want to turn your attention to the screen as we watch a short video presentation that captures a bit about what's been going on within CardinalStone, and also some products for you. Information they want to pass across. First of all, CardinalStone Securities, making waves, continues to lead the markets. And then, of course, that product, the CardinalStone Infrastructure Fund, something for you to consider as well as you look to diversify your portfolios. Right now, we're going to go into the panel session where we're going to really take your questions, engage our speakers and panelists a lot more, and hopefully get all the knowledge we need over the next hour or so before we round things up. I'd like to invite again our keynote speaker to just join us on the stage. Please put your hands together for him again, Mr. Michael Olufemi Olaride. He's the head of Fiscal and Tax Reforms Division at the FIRS. Joining him on the stage, we have Mrs. Esiri Agbeyi. A round of applause for her as she steps forward. She's a partner and Africa Family Business Leader at PwC Nigeria. Thank you so much, Esiri, for joining us. And we also have joining us for this, Mr. Suleiman Yahaya. A round of applause for him as well as he steps forward. He is a partner, private client and family wealth at Anderson, Nigeria. Thank you so much for joining us. And I would be stepping to the stage as well to join them for this interaction. We want to encourage our audience joining us virtually as well to get ready. We'll be taking your questions as we go along as well. Move over to the stage. Thank you all for joining us. As you can tell, it's a hot topic. Unless, of course, you've been living under a rock in Nigeria. Everyone is wondering what's going to be my fate. Should I start handling cash and putting it under the bed? Or, when are they going to start coming after my business? What's going to the audits look like? Hopefully we can get some clarity on all of that as we move along. But maybe to start off, at a high level, Siri, maybe you can just give us your thoughts about how these reforms are likely to impact wealth. There's obviously the issue about capital gains tax. That's obviously new. How do you see this impacting wealth? And then maybe also at a high level, what would be your high level advice to people in terms of how they should begin to reorganize themselves? So we're talking about people who have things like estates, they have trust, etc. Can you just speak to that?
Yeah, thanks, Wole, and good morning, everyone. It's a pleasure to be here. Thank you, CardinalStone, for organizing this. I think the reform presents a plethora of opportunities, but it also does highlight certain challenges that need to pay attention to, especially now that we sort of have a transition timeline to 1st of January when the laws will actually take effect. So prior to now, I think a number of people have started to actually look into their portfolios to identify what kind of structuring advantage can be had and put them to use. One of the big changes that we're seeing, and Michael spoke to that earlier, is the fact that we're now moving to a progressive regime. And so it does mean that in some cases, your CGT rate where you do dispose of assets may be higher. It's good to know that the reform has taken into consideration quite a number of low-income earners, but what you do find is that the first big income tax bracket, the rate is now 15% as opposed to 7% that we had previously. So it's really going to catch up with a lot of high-income earners than we had before. Second is the fact that we do have an expansive base of assets that will be taxed, one of which is virtual assets, so cryptos will now be taxed as well. And I think there are very clear rules around the fact that you can also take a deduction of those losses. It's good to take into consideration the fact that this provision around deduction of capital losses is not just coming on board for the first time, because we did have it from the Finance Act of 2023. So something that investors can also start to think through to say, which losses can I carry forward into the new tax year of 2026? Other things would be around the valuation of those assets. What's going to be the value? Because you do have room for exemptions. And unfortunately, those exemptions are mostly skewed to shares, equities. So structuring would be one thing. How do I want to structure assets in terms of investing? Should it be through equities, or can I consider loan notes? Because we also now have an indirect tax charge on shares, you then find that other asset categories are excluded from the indirect tax charge, and perhaps that's where the planning can be around. On valuation of assets, very critical, because again, like I said, the exemption is at a minimum of 10 million. If you had profits or gains of that and below, it's exempt. And if you had proceeds of about 100 million, also exempt. So that means how you value the assets is critical. What cost you take into consideration. And one of the big areas that we're seeing a lot of uncertainty is around the valuation of how to value assets like art. So for estates, for instance, where you're transferring some of that portfolio into the new structures because there might be some advantage, you want to then consider what are the values of those assets. Private shares, for instance, that are not publicly listed, how do we value those? How do we move them into this new portfolio? What could be the potential gain, if any? And then I think the last point to touch on is around trust structures. This is also something that is usually used by families and estates, is to understand what's the implication. Maybe I'd add one more point before I give the mic over, is with individuals, you can be resident in Nigeria, not just because you're a Nigerian, but because you have a physical home that's permanent in Nigeria, and then have to pay tax on your worldwide income. Two is for corporates. Corporates can also be residents in Nigeria, and the way you look at that is how you manage, and the way you look at that is how you manage your affairs. So it's not just your affairs. So it's not just the incorporation. Reduce the leakage as much as possible for Nigeria. Reduce the leakage as much as possible for Nigeria. And that means ensuring that we align with what's going on globally. Ensuring that we align with what's going on globally.
Thank you so much. Thank you so much. That's fairly comprehensive overview, and we'll be unpacking a lot. Fairly comprehensive overview, and we'll be unpacking a lot more as we go along. Suleiman, maybe you can also chime in, and the thing
For inviting me. So I think with the tax reform, it's a lot, right? And everyone seems to be overwhelmed at the moment, right? So there are quite a number of changes. Esiri had actually mentioned a number of them. But I think just to add to what she has said, there are a few provisions that are very important to know, right? Which is what you call control foreign corporations rule, rate of less than 15%. Then the Nigerian parent company will need to pay the top-up taxes, right? Now, those are very important and fundamental provisions that will really affect, your structuring. But overall,
on monthly transactions for individuals that exceed 25 million cumulatively, and for corporates that exceed 100 million in a month cumulatively. Because those reports are going to happen, it's important that investors and players in the market also track that religiously. And also because there are investment exemptions. So if you do a reinvestment in the same asset class, it's exempt. But those exemptions are reinvestments are something that you also then want to manage so that you can exclude them from the tax calculation. Before now, or currently, we also used to have 2 reporting timelines in the year for June and December. But now, because you've merged that into income tax, you're only going to be filing the return once. So that gives you ample time to do all of that analysis.
When would that return be filed?
It will be filed on the platform annually.
I mean, when would it be expected? That's right.
6 months after your accounting year end. So if you were a December year end, you would file that in June. If you're a March year end, you file that in September.
So this implies that really the first filings will be in 2027 for someone who has a December year end.
For the December year ends, correct.
Understood. Okay. What about individuals? Well, I mean, we have HNIs that do huge volumes in the stock market as well. How would you recommend that they invest going forward? For example, do you think it might be better suited to have a corporate structure as your SPV, so to speak, when you begin to invest in shares?
Yeah, so I think having a holding structure in Nigeria makes a lot of sense, and then identifying those vehicles according to the asset types as well is important so that you're investing in probably similar asset classes. The other thing, and maybe that's to the point around the question on foreign investors, is the currency of the transaction. Because of the inflation risk we have and the foreign exchange devaluation, all of a sudden, because you dispose of an asset in Naira, there might be a huge perceived gain. Monies were translated into Naira, and now I want to pull out. When I'm selling, what rate am I selling at, and in what currency am I selling at? That depends also in dollars. But of course, when you're calculating the gain, it's not whether you took it out in dollars, it's really what was the currency of the transaction. And if it was in Naira, all of a sudden there's a huge gain that you have to pay taxes on. So it means that there's going to be some sort of bias to who I'm going to be selling those assets to, foreign investors that can give me foreign currency. And then perhaps the question is, at what level am I making those disposals? Is it at the Nigerian level, or am I making it at a level above in a foreign jurisdiction so that it can allow preservation of value in foreign currency? So those are some of the concerns, because if I take, for instance, one of the transaction or deal we looked at recently, if we looked at it in local currency, there was a huge loss. But if we looked at it in
have you speak to this point? Clearly, with all these type of reforms, and you've probably given it some thoughts, this is just a general question. Where do you think we are likely to see, should I say, challenges with either compliance or issues that maybe those who are crafting these laws have not really taken into account that practically will now be an issue as we begin to implement? I wonder if there are some points like that you've been able to highlight.
Okay, so I think as we speak, there are quite a number of areas where the implementation of this of the new act, right? One clear area, it's what she mentioned. For instance, in terms of valuation of those investments, right? So an entity, should pay up that amount. I mean, that's an area also, that needs to be looked at. So I believe as we go along, what's more important is to get educated, right, in terms of what these changes are and how they impact you, and then we can then continue to look at how to, yeah.
Before I take questions from the room, I just want to go back to Michael. And clearly, I'm sure a lot of thought has gone into these reforms, and there will be a huge expectation that revenues are going to go up. In fact, some people are suggesting that they will be unbelievable because we know, one, these reforms have been long overdue. They haven't been reformed in a long time. Many people have not been in the tax net that would now become in the tax net. And then potentially as well, the efforts to drive compliance.
A lot of reforms has given away. Look at the VAT, unrestricted VAT claims, for instance. I imagine an asset like Dangote refinery, trying to claim the input VAT of building that refinery. All the equipment that's put there, and you know how long it will take to claim the input VAT. Even, let's look at manufacturing businesses. Manufacturing buys equipment. Today you can claim them. You don't claim anything. Now everyone starts claiming. Look at exempt goods. Exempt goods, or zero-rated goods rather. You purchase goods and you get input VAT. And because you cannot collect output, there's no claim. What you actually have to do is to put such input VAT on the costs and mark it up with your pricing. But today, the law is saying claim them. What it means is that government is going to be giving refunds. And the law have even said you must give that refund within 30 days. So these are, and looking at many other, many states have even complained that they will not have people paying taxes. Because look at some states, let's say you go to a place like, without any form of discrimination, you go to a place like Ebonyi, you go to a place like Zamfara, you go to a place like, where should I say, I'm trying to look at a southwest state too, Kwara, and look at the level of people who earn minimum wage, or the population of people. And today, how many of the HNIs do we actually pay taxes, or the right amount of taxes? So we know that one HNI tax can take care of even 100 persons tax. But how accessible has the state been able to collect that? So we're looking at those kind of revenue. We know that when the system becomes better, and that's why many of the businesses, many of the reforms is encouraging formalization. So when you ask Siri about a question whether it's better to for an individual to go corporate or I was looking at, it's better to go corporate as far as I'm concerned, because when you formalize, you have access to better incentives and better claims than an individual where the state will chase after you. And definitely, for the most efficient states, they will ensure they collect the best of taxes, like Lagos State. So, by and large, we know later what it's going to do is going to expand the base. And when the base is expanded, government will start making that revenue that you call huge. But for me, we don't see it coming in the short time.
I'm just curious on the point about residency, because if Nigerians who live abroad obviously don't live in the country, and I know that where you're resident plays a role in who that tax is remitted to. So how is that worked out under this structure? I'm just curious. It may even be something that...
Okay, that's simple. We have those that are called non-residents.
Yes.
And they say before you are, as a non-resident, before you are charged to tax in Nigeria, you must have met some threshold. So under our present law, we have what we call Section 13(2), where you tax persons who are not residents in Nigeria. And they must have met some criteria, and the common one now is what we call the significant economic presence. So you see that you've done business in Nigeria and you've met a certain threshold.
Well, if you don't meet that threshold and there's significant economic presence, which state will you now be assigned to?
No. So that's now in the purview of the federal government. So once you're a non-resident, you pay to federal government.
Okay,
which is under the
so it won't go to any state.
No,
in this case.
It doesn't go.
So
but it's still, all the taxes collected by the federal government basically still shared among the states. So
you wanted to say something, Siri, before I go to the audience? I'm sure they are very keen.
I think the other part then for that residency would be at the individual level, because that's where the state then gets involved. So if you're a resident of Nigeria because you have your physical home here, then you pay the taxes all to Nigeria. Yes, in the states where that residence is established, say your physical home, permanent home is in Lagos. Yeah.
Okay.
Just to add, I think the updates on that residency rule also suggests that if you have family ties, right, in Nigeria, then you may be deemed to be resident in Nigeria, and that kind of presents.
No, it's not just family ties. You have family. That means you can be traced to
immediate family.
There,
absolutely.
To be living there. So.
What does family mean? Because
the residency rule is
still
my
wife
there.
Is family,
The residency rule of 183 days is there. Then for those who cannot easily, you have a property where your family resides in.
Family who? Who is family? Okay. Is that defined? I'm just curious.
So I think that's the definition. Okay.
So there were different versions of the act before they finally gazetted one version that we have now. In the previous versions, there were actually family ties. The family in that place really is your immediate family. So most times in tax laws internationally, it's your immediate family that's looked at. So your wife, your husband, your children, not necessarily your extended family. But because it also talks about substantive economic ties, you don't only look at family, you also look at whether you're doing significant business in country. So some of us may have EB4 visas, or you have a visa in another country, but your main income generator is here. That's a substantive economic tie, even if you didn't have family here. So that section was taken out in the final version that was gazetted, and we were then only left with the domicile test, where you're domiciled, so where you have a legal presence, and then your physical home. Those were left. And then for Nigeria diplomats that work abroad, automatically you're a Nigerian resident. But for the non-residents, those tests were still retained. Substantive economic ties, substantive family ties, 183-day rule. So they don't mirror themselves when you look at the definition of a resident and a non-resident. I don't know whether that's an error, but the truth is that in between that, there would be a gap where you then ask yourself, I'm a Nigerian. I didn't spend 183 days here. Am I taxable? If you have a physical home, you are taxable. If you have NIN, you are taxable. So those are some of the things that
If you have NIN,
you might
because
just
you have
be
to have
taxable.
NIN to have a passport now.
Yes.
So which means
yes.
if you have a passport,
so there are
you
some
are
of those
taxable.
things that may be indicators for you being resident here, and it's a test that you must carry out individually to assess before you then say, okay, I'm taxable. But then once you've done that, there's actually relief available. So it doesn't just leave you stranded. It says that you will then be able to set off the taxes you've paid in other jurisdictions against what you have to pay in Nigeria, whether or not there is a tax treaty. So even if there is no tax treaty, just bring those taxes, and Nigeria gives you a unilateral relief. So it's not double taxation.
Okay, I'm sure many will be happy to hear that. Okay, so let's go into the audience now. We have a hand there, we have a hand here, we have hand here, hand here. So we will come one by one, and I would really appreciate if you can be very concise so we can take as many questions as possible.
Hi, Shane once again. Just to be absolutely clear, from a practicality standpoint, if you're in employment and you pay income tax based on your salary and you're trading as well, how do you incorporate the capital gains tax from trading into your personal income tax? And then what's the definition of capital gain tax? Is it just subject to equity trading, or does it include property sales or other things? Thank you.
Okay. I was going to take many questions at once, but let's, so that we don't lose that, I think it's a very important question, very practical. Michael, would you like to speak to that?
Okay.
I hope it was clear.
So I used to say something that we no longer have capital gains tax, but we have tax on capital gains. So now, when you say capital gains tax, it means there's a tax called capital gains tax, a distinct tax that we used to have before, like 10%. Now we have tax on your capital gains. So now what we operate in Nigeria is still voluntary compliance, a self-assessment regime. So when you are in employment and your employer has deducted your payee, what the law says is that by 31st of every year, you should prepare your own returns and file your returns. And when you're filing your returns, in computation of your tax, you still take into consideration all the provisions of the law. Now you add the gains you have made outside your employment, other income you have made. And when you say capital gains tax, yes, every chargeable assets, whether shares, digital assets, whether you're trading cryptocurrency, you dispose your property, the gains you've made from there, they are all chargeable gains.
At what rate?
No, not rate now. So what you do, you add your income. Your income. Whether from employment or any other place.
So it will be like other income, so to speak.
Yeah,
assuming that your employment
income
is your main income.
Yes.
So all that will be other income. If we stock accounting.
Yes, now you're going to accounting. Now you apply what we call the table of tax rates. The table of tax rate has also changed. For many, they'll be having a lower tax. For those HNI, may have like a 1% higher. But for many, we try to do a simulation, and I think from under 20 million, you should be having about lower tax for people who earn under 20 million. So that is how the capital gains will be computed. You say? Yeah. No. So if you do not comply, we do not self-assess yourself, and the tax authority, beyond reasonable doubt, have information and intelligence about you, they could come up with, you say?
Information. Please, can you give him the microphone?
Siri mentioned that now there's going to be a lot of sharing of information.
So like your bank records.
So confirmed records. So, and one thing is, when you say, when a tax authority comes forward with an assessment for you, you still have the right of appeal. And the only time they come forward is because you have not volunteered that information. So most of the time, or you volunteer, you under-declare. So those are the issues.
I have a very short question relating to assessment. Okay. Does the law now mandate, just like you have, say, in the United States, where every person has to self-assess and put out their records out there?
It has always been that.
It has always been there?
Yes.
But people don't do it?
So if I ask everybody in this room who has filed their returns for this year, I'm sure we may have less than 5%.
Right. So what would be the implication of that?
So the implication is that
if you don't self-assess,
it's an offense.
It's an offense.
In fact, it is. You can be prosecuted.
Right. And for not self-assessing.
For not filing your returns.
For not filing your returns. That's what I mean. Yeah. Sorry. Okay. Interesting. Okay.
Just to add, to say that even when you have self-assessed and declare all your income, right? And the tax authority is of the view that you haven't fully declared, right? They can actually, the law empowers them to come and engage you just with a view to confirming that you have declared your entire income, and you can be asked to, you know, provide additional documents, provide your bank statements, right, and all of that. Yeah.
Which authority would do that? Because we always had the local internal revenue service for the state, and then you have the federal. I'm just wondering, how is that going to work practically going forward now? Is anything changing?
No, nothing is changing. Depending on the person, who, if it's an individual, and if it is the corporate. So the corporate, of course, you know, is the Federal Land Revenue Service. And you know, what I always tell people is that even a government agency will, a tax authority will first evaluate who they want to go after, raising additional assessment, and it's only when they have, beyond their intelligence, brought them to big incomes, and that's not been so declared. And so, but what I would advise going forward is that people should adopt the culture of self-assessment and filing their returns, because it's easier for tax authorities to now get the information and also raise assessments. So tax authorities can raise assessment even via your WhatsApp today and tell you, oh, we have intelligence that you have earned so income for the year, and this is your assessment. It is allowed.
All right. It's a new day. Okay, can we take another question? Can we move to the front of the room on this side? Please, if we can be concise, so we can take more questions.
Okay, thank you. Ifeoma here. So I just wanted to know, because, you know, the tax reforms, there will be implementation.
Sorry, just checking, is the microphone on? Can you just double check?
Yeah, it is.
Okay.
So I just wanted to know, with the implementation, of course, there are many interpretations. You can understand that from the room. So is there a clear process for remediation, for tax rebates? If, for example, I feel I've been overcharged on tax, I go to a taxman and say, okay, I've reviewed this and all that. Is there a clear process for remediation to ask for tax rebates? And then on the second question would be around SMEs that do not really have, you know, in Nigeria, we have a lot of small businesses that do not have audited accounts, I mean, the way corporates have it. How do we want to help these kinds of people? Because we know tax only comes to play. Maybe someone's child wants to travel for school, you want to get FX, they say, okay, now you must show us your tax document. What is it? Because I still see that this tax is going to be so skewed. It will be more on people that have clear documentations, corporate, salaried people, and all of that. So the two questions. Thank you.
Should I go?
Yes, sir. Please.
Oh, okay.
You are the FIRS.
So it's actually, now you just made a confession. You said, you know, we only care about this when we need to get... you're asking for a friend. So I did a presentation in a church last week. And you know, when you go to church and the pastor finished preaching and people start confessing. So I had same on a church invited me to speak on tax reforms. And after, some people say, you know, I've never paid tax in my life. And you know, even the pastor of the church, one had to say, I do business. So this is what happens. Now, even for, so you're asking how with the SMEs that don't have books and all those things. Now, the law is even allowing SMEs to be able to file returns in a simpler form. The law allows tax authority to develop simpler forms that people can use to file, and so not audited statements. So many can do that. Now, we are also going to an era of fiscalization and e-invoicing. And when we say fiscal, so the tax authority will develop, for those who that do not have the proper accounting system, the tax authority will be providing a way of reporting their transactions. And these transactions will definitely, the way of reporting may be in form of simplified accounting statements. And so, but by and large, the law still puts it on you for you to prepare your records So when you are a corporate, whether small business or no, you are supposed to. But the invoicing is also taking you to an area where we will be going for a pre-filled, where the system already pre-fill your returns for you, and it just push it to you and say, have you done this? But without taking away the provision of the law, as a business person, you need to keep your records and you need to file returns. But the records for SMEs, the law allows them to not to be an abridged, not to be like an audited account. So I believe.
All right.
Is it remediation?
Yes, where people do not perhaps agree with the assessment.
Oh, okay.
Practically,
so we already
is there
said
a way to make
we already
it
said what
not
you
too
have,
arduous?
What you have is self-assessment. So I don't believe there's a situation where you do not agree. But where you do not agree, which means that tax authority have visited you, they perform, it's either they have performed a remote audit or they have performed a physical audit. When I say remote audit, they sat in the office, got information about you. A series said it, the financial institutions will be reporting transactions of individuals and companies. Today, there's the NFIU reports, the banks report, and so the tax authority have access to information. Also, for those who are HNIs that receive income from abroad, there's a lot of exchange of information issues. And once the tax authority send that to you, yes, you can appeal. The law allows you to appeal. It gives you 30 days to appeal every assessment that has been raised on you. So it's where you do not appeal that other processes can come up.
Okay, thank you.
Yeah.
Can we move to this side of the room?
Thank you.
Real quick, if you can,
Hello.
please.
So the administration is also strengthened with the tax ombuds that's going to be set up.
The tax what?
The tax ombuds. So there's an organization that's going to be called the tax ombuds, members of which will be appointed by the president, that will be supporting also taxpayers with advocacies and issues like remediation that you mentioned.
Thank you for that.
But however, tax ombuds cannot do assessments.
No, the tax ombuds can't do the assessment.
Deal with assessment.
Right.
So if you disagree with assessment, it can't help you. You have to go to TAT.
Right. Let's have a question.
Hello.
Please.
Hi, good afternoon. My name is Koinsala Jide, and I'm just a regular real estate broker in Lagos, Nigeria. My question is very simple and straight to the point. How might the tax reforms affect your valuation assumptions in terms of tax rate expectations and reinvestment incentives for Nigerian investment? So, as someone who is a real estate broker in Lagos, Nigeria, and say I have a client and I wanted the client to reinvest, whatever it is they have put in my company or in whatever it is I'm doing, and do investment banking. And most times with real estate, you can't necessarily, I think she mentioned something about the price of dollar and all of that, and how when sometimes you earn in dollar, the value is not compared to when it's in naira, because the devaluation rate has increased, increasingly and alarmingly. So my question is, what exactly should we be expecting as a sort of valuation return for that kind of investment on the tax rate? I hope I'm quite, concise, and I hope I'm comprehensive. Do you understand what I'm trying to say? You don't understand? All right, let me repeat it again.
Can you, very quickly, if you can, maybe use a practical example to illustrate what you're trying to say?
Okay, let me say the question straight up without any other thing, right? How might the tax reforms affect your valuation assumptions, right? Based on tax rate expectation, free cash flow growth, reinvestment incentive, cost of capital for the Nigerian investment. Does that make more sense? It still doesn't make any sense.
We answer according to...
I think the main issue there, as I understand it, is the valuation assumptions. What would be the valuation assumptions that would be brought to bear in tax assessments? I think that's, if I can just, that's essentially what she's trying to say.
Yeah, so...
and to give context, she said she's into the real estate space.
Yeah.
So what exactly would be there? And then you made a point in terms of saying something about family this or family that or whatever that case may be. What if the person is a Nigerian, right, but resides there and has a property here and is trying to maybe buy another property? Yes. And is trying to buy another property somewhere here. How is it that they would buy it in a way where their value of dollar and what the case, doesn't deplete? And then what kind of tax will be put on them? Because they are family too. They live here. They just probably went there for maybe jackpot things or something. But they just want to come back home, or they just want to have a home. Do you understand what I'm trying to say? Is it a bit more comprehensive?
So let me just try, and then maybe the other panelists can add. In terms of the valuation data or the assumptions that you use to build the valuation of your assets, you need to take into consideration the changes in the tax rates, because those are critical for determining your after-tax profits. Number two is the fact that you have certain incentives as well that you could take advantage of that would reduce overall the tax outlook for those investments. So we have now the economic development investment framework as opposed to the priority sectors that gives you some break. All of the taxes that you could have paid in a certain year automatically becomes a credit, and that credit can be used to relieve or offset taxes that you would ordinarily have paid to the government. Again, that increases the valuation of your building. Then in terms of VAT, because now VAT, you can recover most of the input VAT on fixed assets and on overheads. Prior to now, you couldn't. So most service-driven entities couldn't reclaim their VAT. That means that your cost base is significant, and then your profit is lower. Yeah? So now that you can recover it, it gives you some room ahead for increasing that profit. Now, the thing about planning around that is, in the real estate sector, you want to ask yourself, if I'm not going to charge VAT when I rent the property, I can't reclaim that VAT. But if I can charge VAT when I provide facility management services, I can reclaim some of that VAT. So it means that there are mixed supplies now in the real estate space, and you need to think around the right vehicle for delivering either the services and owning the property. The second thing is for the investor that's going to dispose of shares in those vehicles. You want to ask yourself, where am I disposing the shares? Is it in the Nigerian entity or in the foreign entity? If you want to pass those investments through a foreign vehicle down to Nigeria, those are the kind of considerations that you look at, because you think it's a faster exit outside than in Nigeria. The third thing is, because now there are indirect tax rules where you dispose of shares. So you have a Nigerian vehicle that you pay Nigerian tax. So all of a sudden you're seeing that it's going outside of the jurisdiction. You then ask yourself, how do you want to value those assets? So if you're a very real estate savvy person and you have real estate portfolio in Nigeria, Ghana, Tanzania, Uganda, Rwanda, even the US, do you want to put all of those value? All of the value from those companies have contributed to the value in the holding company. So you want to be able to segregate it. So when you're doing now the valuation for some of these and then saying this is attractive for a foreign investor, the structuring around those asset ownerships is critical. The way you even exit those vehicles is also important, because if they say now that on that indirect layering, it's only where you indirectly sell shares that I'm going to hit you with tax, you then ask yourself, what financial structuring can happen so that I don't dispose of shares, I dispose of another type of instrument? And that could be maybe a loan note. So it's making the conversation around structuring a lot more important, and the path you choose increases the value that's available for distribution to your investors. So I hope I've been able to.
Thank you very much for that effort. Appreciate it. Okay. in the interest of fairness, I haven't taken any question from this side. Can we take one from close to the front of the room, please?
Sorry, mine is a simple. My name is Wale Sulaiman. Is there any benefit in the Tax Act for pensioners and retirees over 70 and 80 above?
Short answer, if we can get one, please.
Okay, in our law today, pensioners and retirees are not paid, they don't pay income tax on those pension income. However, well, that is it, because that's what they are known as, pensioners and retirees. But if they, of course, if they are in business, of course, income from business
will be taxed
taxable
on that. Okay.
So
thank you.
it's not because of their name.
All right. Let's take one from front of the room. Thank you.
Thank you very much. Good morning, everyone. Good morning, panelists, and thank you for the opportunity. My name is Yetunde Adebambo. Yes, from African Capital Alliance. So a quick one. So we have just what Esiri described. We have investors that come here, invest in, coming with their USD. The USD is converted, they get Naira, and the Naira is invested here in Nigeria. And then, at the time they dispose of the assets, the asset is disposed and they get Naira, and we convert with the CCI and then repatriate the funds. Now, this is the question. We have a particular case. These investors came in when Naira to dollar was at 360. And now today, Naira to dollar is at 1.5. Already, from a Naira perspective, they have made significant, gains. But if you look at it from a USD perspective, they have, So now,
please, can you go to the question? I'm
yes.
so sorry.
Okay, I'm sorry. So the question is there any provision in the law that permits CGT to be computed in USD? So you can look at it from that perspective. Did they make a gain? 1, 2, in your computation of CGT, would you factor in the FX losses that they have made? And the third question is around, around the withholding tax on dividends. I wanted to clarify the interaction between the withholding tax on dividends and the CGT, the tax on capital gains, right? Are investors experiencing a combined tax rate in this case? Thank you very much.
Sir, can you speak to that or someone else?
Maybe let's learn.
Okay, they want you, sir. They want you. Okay, please, if you can give a short answer, I'll be grateful, because we are pressed for time.
Let me start from the back. So withholding tax and CGT is not something that applies at the same time. So on dividend most of the time it becomes frank investment income. So the one for CGT is when the CGT is disposed as like a trading gain, But if it's the one, it's on dividend, it becomes your, it's not tax again. So the withholding tax is one on that one. So what's the other question?
Question on.
Oh, okay.
FX losses, and will there be a focus on dollar-based
you asked one
computation?
The first question you asked whether we will consider collecting the tax in dollars. Yes, we will be happy to collect that one.
I'm not sure that one. Will you compute the tax?
No. If
based on dollar-based income, dollar-based, the dollar value of the
dollar value.
Yes.
So if you can
of the capital gains.
So now, for the tax man, the first thing is that we study all those, you study all those implications. Before the law says that you compute your tax and pay your tax in the currency of transaction. So what has changed in the law right now is where your tax is currency of transaction is in dollar, or the rest the law allows you to now pay in Naira. However, it has to be prevailing exchange rate. It's prevailing exchange rate.
In dollar terms, a transaction, currency. And if you invested in Naira,
so what did you invest in? No. What you have made, the investment is either on the capital market or or money market.
It could be FDI, it could be,
or it could be FDI. Now, no, the real investment,
and you could sell that
brought about So the
Because
gain,
they're in private
what's the
equity.
transaction? No, you bring in money into Nigeria. That's an equity, right? There is no investment yet. When you now invest, you say you're going to convert the money before investing.
Yes.
Now, is that investment that now brings about, which is the economic activity that brings about either a gain or a loss?
Yes.
Now, where there is a gain, what you now invested with either Naira on the
Yes.
capital market. The gain is also
Not necessarily capital market. It could be a company.
So if you
they're
have,
into private equity, so they buy companies in quotes.
so if you
Buy-
invested in the
and
company,
they can now sell that investment.
no, if you invested in company with the dollar you brought,
Yes.
at least that can be tracked that you invested in the dollar you brought, and in breaking.
But they have to convert it first. They convert it first. So let me give you a quick example. I have $1
So
million.
what you want to ask is if exchange losses are allowed.
Yes. In a sense, that's the
so
implication.
all the places you are going to.
I bring $1 million, I convert it to Naira. Today, that Naira is 50 million, but in dollars, it's $500,000. That's so. The question is, how do I pay tax on that? Because from a foreign investor perspective, I have actually made a loss.
And we have investors pulling out already. Investors are pulling out and they're saying, I can't do this. Because the FX, there's volatility FX, and then they are making them pay additional taxes.
Well, the tax law does not address that.
Consider that.
For the tax law actually have not. The tax law try to address most of these losses you make. I think it should be allowed. It should be allowed because now, if you're doing business based on the new, all losses should be allowed. Now, if everything is, if you prepare your accounts well, but I'm not, the way you prepare your accounts, do you start with the Naira exchange, or you start, you start with the dollar?
It's Naira. The investment was made in Naira, but they brought dollars in.
How do you report that? How do you report that?
No, we're looking at it from the perspective of the foreign investor. The foreign investor brought his $1 million. He changed it to Naira. He put that $1 million in a company. That company, maybe at the time, was 10 million Naira. Today, that company is 100 million Naira. But at the exchange rate today, that 1 million I brought is now $500,000. So I have not made a gain as a foreign investor. I've actually made a loss. But in Naira terms, I have made a gain. So
Yeah,
how is this addressed?
Can I?
Okay. Yes, please. Yes.
Okay, maybe if I can just share my perspective. The question is, at what point are you exiting? Because usually with foreign investors, they most likely will have an offshore company, right? Invest there in USD, right? Then that company will invest the FX into a Nigerian business, right? Now, most times the exit will happen at the level of the offshore company, isn't it?
No.
Okay.
No, they're investing in a Nigerian company.
Yeah, so it could be two.
No,
I understand. So it could be two variants. Now, if the exit is happening in the Nigerian company, right? I think what Mr. Michael is struggling with is to say that the FX loss will not be allowed. I think. No. Yeah, just hold on. Yeah, just hold. So, and the reason is the strict interpretation of the way the law is written. It says sale of shares in a Nigerian company, subject to this, whatever, will be liable to capital gains tax, right? Now, personally, I believe that if you go through the strict interpretation of the law, the FRS or tax authority can argue that the CGT is liable. But I think the tax authority can be engaged, to say, this is what I've invested in FX. In actual sense, I've not made a loss, right?
Is there a room for this
I've not made
type
a
of
gain.
engagement? I'm just curious, because we have to round this up now. Situations that maybe the law has not considered, and it's practical, just like we're seeing now. You're asking me to pay capital gains on a situation that I'm actually losing. Is there an opening in any form for this type of interaction?
No, yeah, definitely there is, everything is allowed for engagement. And this is actually a very good feedback too. Like you said, we are drafting regulations now. They are drafting a lot of regulations for the application of the law. Now, these are provisions that will be very clear in those regulations to address all these concerns. So I'll probably take this as a feedback too.
We appreciate that, sir. That's the whole point of this event. So you can take the feedback. And we thank you for accepting to do so. We have so many questions online, and we've pretty much run out of time. So I'm really not sure what to do now because, as you can see, the audience wants to engage more. So can I appeal that perhaps right after we, close out, you can, and I'm sure they'll be open to engaging on a one-on-one level so that we can close out the event. So I think on that note, I would like to ask that we please put our hands together for the panelists. I think it has been very interactive, very engaging, very informative. And so we'll take a few photographs now before we close out. Yes, so I think perhaps it's best to stand here for the photographs. Photographers, what do you advise? Or do we still stay here? For lighting, maybe it's better here, right? Sorry? Oh, yes. Yes, absolutely. Okay, we do have some gifts for our speakers, so can we organize that now? I'd like to invite Ayola, MD of CardinalStone Finance, to present the gifts to our speakers. Thank you very much. Have something to say.
Good afternoon, everyone. On behalf of CardinalStone and our esteemed clients, both presented this morning and the ones joining us virtually, we'd like to say a big thank you to our distinguished speakers. Thank you very much for the time. Your clarity and insight have really been helpful, and I think it has been of great value to everyone present at this event this morning, both physically and virtually. Thank you very much. Please join me in giving them a warm round of applause. Please, can we have the gifts? Thank you very much. Thank you very much, sir. Thank you very much, Michael.
All right. Can we just... Sure. Thank you. Please, if you can just, I would like to invite some CardinalStone executives to join them, please. So the MDs and directors, please. Oh, Shay. Thank you. Do you want them?
No, 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 no. Mr. Jailer. I have years, you have years too.
Sorry?
I've died, but you
Okay, we're not quite done, please. I promise we're out in a second. You can just take our seats for a moment. I would like to now invite to deliver vote of thanks, the co-founder of CardinalStone Partners, Femi Ogujimi. Please a round of applause for him. Thank you so much.
Good afternoon, everyone. I'll be very quick on this. It's my great pleasure to deliver the vote of thanks on behalf of CardinalStone to close out this discussion. First and foremost, I'd like to express our deepest gratitude to our keynote speaker, Mr. Michael Larinde, for his enlightening presentation. Your insights on the changes in the tax regime have given us much to reflect upon and apply in our respective institutions and personal affairs. We also extend our heartfelt thanks to our panelists for the rich discussion and practical perspectives on the subject matter. Your expertise has helped us to connect theory with real-world practice. We thank our distinguished guests and participants who have joined us in person and online. Your active engagements, thoughtful questions, and networking spirits have truly made this conversation a success. Finally, as we conclude, we hope that you can take the ideas from here forward and build upon them. We advise that you consult your tax consultants, and I do appeal to all of you that you please allow Mr. Allowing the safe passage so that he can come back again to address us another time. This has all been done in the best interest of Nigeria, and we do believe that with time, whatever clarifications need to be done will be done. Thank you very much. We do appreciate your time. Have a great day.
Thank you very much, Femi. Thank you, everyone. Like I did promise, you can also engage after this. There's still some coffee and finger food outside if you want some. And thank you again for coming. Thank you, CardinalStone, for putting this together. I hope it has been a valuable time.
We don't have to go the 360 degrees. Now it's time to go the 180. You don't have to climb the highest mountains. For all you're looking for is within you. Open the eyes of your mind, your ears and mouth, as I sing my song. Open the eyes of your mind, your ears and mouth, as you